FedEx, formerly known as Federal Express, is a quasi-cyclical company that is somewhat dependent on the state of the economy and the cyclical nature of the economy. As you can see by the operating earnings here, the company has had cycles. Even through the Great Recession, the company's earnings did drop a couple of years in a row. They've had a drop in earnings during COVID, and they've recently had a drop in earnings, which I do want to talk about in this video. But if you look long term at the weekly closing stock prices, you can see that stock prices generally go where the company's operating results have gone. And through all the cyclicality, the company that has grown at almost double-digit rates, and their dividend record has been stellar, except for a couple of years in the middle here where they froze the dividend temporarily. And I'll talk about that in the video. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And I'm going to produce an update on FedEx here with this video. And it's a stock that I am long on in our managed portfolios. And what we've done here, we want to showcase something and do something a little differently for you. We're going to produce an updated video. We've done videos on FedEx a couple of times in the past. And what we're going to talk about here is what the prospects of the company look like going forward, whether you would consider it a buy, sell, or a hold currently. But I also want to add something, a new feature that we're going to be adding. In cooperation with James Long, we've also produced a research report on FedEx, which we're going to have a link in this video to. So what we're going to do in the video is do a high-level overview via Fast Graphs, where we look at the fundamentals and the numbers, at the high level, and then we're going to provide a link that takes you directly to the Fast Graph website that will show you and present for you a more comprehensive research report in the company. So I hope you find that meaningful. We're going to be trying to do this maybe once a week from now on, where we feature a company, and rather than just showing you a research candidate, we're going to give you some comprehensive fundamental research and due diligence. Because as I always say, there is no substitute for comprehensive research and due diligence. Anyway, let's get started going through the Fast Graphs. And the fact that, even considering the fact that this has been a cyclical company, the market has consistently valued FedEx at somewhere between 15 and 17 times earnings. That's the blue line is 17.36 times earnings, which is the normal PE going all the way back to 2003. And then the orange line is a PE of 15, which represents an earnings yield of 6.36%, which is attractive. Now, currently, the earnings yield is 7.38%, so that's above, what our minimum threshold is. But I do want to point out that the company has had some issues during COVID. They had a down year in earnings, and then they had a down year of earnings in fiscal year 2022. And by the way, the company has a May fiscal year. So fiscal 2023 ends in just a couple of months. We're in the, late in the third quarter for this company's fiscal year this year. And that's something you need to consider when you're evaluating this company. Now, the stock, because of the weakness here that we saw and some other issues, which we'll talk about, and we highlight in the research report, the stock has had pretty abysmal performance from 2021 and 2022. A lot of it justified by fundamentals. But as the market often does, the market overreacted to the negative results here. And as you can see, the company has recovered almost over 45% off of its low. Now, the question is, where does it stand today? It's got an attractive earnings yield. It's got a 2.17% current dividend yield. So would you classify this as a buy, sell, or hold? For my money, I would call this a hold. I'm not sure I would want to be buying FedEx at today's prices, but that simply means that it's fairly valued today. It doesn't offer you a margin of safety or a significant level of undervaluation, but it's not overvalued by any stretch of the imagination. If anything, it's a hold, and it could even be, for those of you who are willing to take a little more risk, I would also consider it a buy at these prices. All right, so let's kind of go through the numbers and look at FedEx a little bit. Now, I do want to talk about the dividend some. The dividend record, if you look at the long-term performance of this company, it's actually outperformed the market ever so slightly on a capital appreciation basis. It's slightly underperformed it on a dividends, and it ended up just slightly underperforming it as a result, or just approximately equaling what the S&P 500 did over this long-term time frame. But as I change time frames, these numbers change, and I do want to make that clear. That's one of the powers of the fast graph analytical tool. But what I want to focus your attention on here is not so much the long-term performance, because valuation adjustments obviously need to be made when you're evaluating that. If you look at FedEx over this time frame, you can see it was reasonably valued at the beginning and then slightly undervalued currently, but we also had the cyclicality that you have to deal with as we're looking at the stock here, as I pointed out. But here's what I want to mention. If you look at the dividend record, the dividend was frozen from fiscal year 2019. They paid $2.60. Then they paid $2.60 in 2020 and also paid $2.60 in 2021. But then they raised their dividend dramatically this year, and let's look at that a little more granularity. So if you look at that, you can see the years where they didn't grow the dividend, which was 2 years in a row. But then if you look at the current fiscal year, the dividend income was 75 cents a share, and then in 2023, they raised it to $1.15 from the 75 cents. So we had some nice growth in 2022 over the frozen dividend, where we went from $2.60 to $3, which is the 15% growth rate. The company does have a good average dividend growth rate, with the exception of freezing the dividend for those couple of years there. So I do want to feature that and focus on that. But let's talking about the dividend. Let's talk about the company and its cash flow. So I'm going to go back to the long-term graph here. And I want to point out that this is really a cash flow generating machine here. And you'll notice that if I get rid of price and get rid of the distraction of price and just look at the level of cash flow supporting and covering the dividend, which they've only been paying since 2003, by the way. And that's very important when I was comparing that against the market. So let's do that. Let's shorten the time frame a little bit over the time frame where they've been, in direct competition with the market. And you can see that the company still underperformed the market on a dividend paying basis, but the dividend has been growing very nicely again, except for those 2 years I've already featured several times. But the point is the cash flow is strong. But now let's go to also the all-important free cash flow, and I want to talk about this a little bit. Cash that FedEx has grown from $3.5 billion to $7 billion from 2017 to 2022. If I go into fund graphs here and go into the financials, I do want you to see that, in that if I go into the in millions graph and then go into the balance sheet and look at the cash and the short-term investments, you can see that it's grown to approximately $7 billion. So the company is really cash rich. Now, they froze the dividend, in 2019 to 2021 during a time when their free cash flow was relatively weak. But the reason their free cash flow was negative and actually weak there was because the company, in spite of growing operating cash flow from $4.9 billion to $9.8 billion over this time frame, the company actually spent a lot of money on CapEx and preparing for future growth, and that's very important to take into consideration. So their total cash outlays in 2022 were $10.1 billion, but operating cash flow actually covered all that. And the point being that they really didn't need any outside sources of cash, because it is a cash-rich company. So even though there is a coincidence here that they might have frozen their dividend during this period of time, the company was still very, very healthy, and it was still generating very, very strong cash flows, because their uses of cash, which is a new feature we'll be adding to fast graphs in the future, they've generated a lot of operating cash flow and exceeding the amount of outlays of cash that they were spending. So, the company is actually performing very, very well on a cash flow basis, and that's something that I think is very important. But let's kind of go into the nitty-gritty here. If I'm looking at it from a standpoint of, is this a good buy, sell, or hold? Now, if I go into the forecasting calculators, I want you to see that we are expecting a 34% decrease in operating earnings this year, adjusted operating earnings. Okay, if I go into diluted earnings, you'll also see that the diluted earnings picture is slightly better. We're only looking at negative 6.81% from the analyst. So the company's done a little better on diluted earnings here, and this would be GAAP earnings. But the point I want to make is we're expecting a strong recovery in earnings in 2024, and then another decent recovery in 2025 by that. And these numbers are pretty consistent across the various services that supply analyst estimates on companies. If you look at their analyst scorecard, with the exception of 2019 and 20, and then a little blip they had in 2013. The company really does have a pretty credible scorecard. So the analysts do tend to get this company right more often than not. And again, in the research report, you will see that we will present reasons why we felt that the earnings missed so badly in 2019 and 2020. So I think that's a nice, important new feature. You know, the price has clearly tracked earning. It does get disconnected from the valuation from time to time, which is normal. But you can see how when the earnings issues came, the stock price reacted to that. But then that was during COVID, and we had a big drop in earnings, even though the company was already following, or the price was already following the earnings down. But then COVID created that flash crash, but then the company recovered almost immediately and went to approaching all-time highs, dropped a little bit, and then approached all-time highs again. And then it got extremely cheap in 2022. And this would have been the best time to buy the stock. The recovery since then, as I mentioned, has been over 45%. And looking forward, the company's earnings are expected to recover, very nicely for 2024 and 2025. And all importantly, their operating cash flow is expected to recover pretty strongly in fiscal year 2024 and 2025. So all in all, this company looks like a very attractively priced stock here from a standpoint of it being in value. It was a margin of safety buy, last year. I don't think it offers a great margin of safety today, but it is fairly valued. So if you were a long-term investor in FedEx, our recommendation would be to continue to hold the stock, because I think you're seeing the recovery has already moved on pretty good. But if you're looking to place new money in stocks, especially new monies in dividend growth stocks, I might say that there are better choices for you out there than FedEx today. But again, if you've held the stock for even the last couple of years or the long term like we have, I would say FedEx is, a stock worth continuing to hold on. Anyway, this has been Chuck Carnevale, thanking you for watching the video. And I do emphasize, and I do want to repeat, check out the research report. We have a link, at the bottom of this video here, and check out what our basic comprehensive thoughts. Remember, there's no substitute for comprehensive research and due diligence. You can do a lot of work with the basic fast graph tool and get some really good insights into what the company looks like and how the market's been valuing it. But again, you really want to get into the nitty-gritty of the business. You got to be willing to do your own research. And that's really what we're trying to display here. We want you to see the kind of research effort that we've done on the stock that led us to the decision that we think FedEx is currently a hold. Hope you enjoyed the video. Give me a like, ring the bell, subscribe to the channel. The channel's been growing very nicely here recently. We want to thank everybody for subscribing to the channel. And take a look at Fast Graphs. What a great tool that can really help you make better decisions on your long-term investment strategies, especially for dividend growth stock investors. Thanks for watching.